For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Oh, my. Welcome. Oh, hi. Hey, hello. Mics are on. We got to be serious here. Professor Rick Plum, Johnny Dean, your podcast host, and my illustrious...
That's a first.
Yeah. Well, I'm telling you, you are my illustrious guest, and you're one of my only guests I ever have because you're always here. Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. We're just having some laughs beforehand. I don't know why. It's kind of like a warm-up before the show gets started.
It's what we do.
It is what we do. But hey, we're talking about a thing today that's it's not serious. It's money, but it's not serious. But in the money world, it is serious. And we're talking about managing risk, not return. I kind of like that title, Manage Risk, Not Return. You know, it has a good ring to it, but it also has a lot of truth in this, Professor Plum. And the funny thing is, you know, if you look at maybe not so much anymore, but there are certain periods of time in history where the stock market's doing great, and all people want to talk about is the rate of return they're getting, or the rate of return that we can help you achieve. Look at this software I have. This will tell you when to buy and sell. And do they still have those programs, by the way? That they were so big in the early 2000s. Are those still around? Have you seen them?
I would imagine they're still around. I haven't heard of them, but then maybe I've just gotten better at tuning things out than I used to be.
Yeah.
So I don't know, but I can't imagine they're not available.
I would imagine that. Yeah,
people were making money.
I would imagine that you could probably find them, but they're ridiculous. But the whole point, of course, was to say, look at the return we're going to get. And a lot of people, I shouldn't say a lot, some people go to an advisor or think of a financial advisor as somebody who can get them the best rate of return possible. And while rate of return is certainly a good thing to have, and I'm not against rate of return, it's wonderful. But as you know, Professor Plum, you really have not much control over it. You certainly have control over the downside of it because oftentimes many people make a really bad move and what could have been a decent rate of return turns into a horrible rate of return. And I'm sure you'd agree with that.
Well, I mean, we have no control and no way to know what's going to happen with a particular or market, a particular investment in the short run. I mean, we've seen this time and time again. People say they can time it, but they may be able to time it 2, 3, 4 times right, and then they start. The problem with that is if you write a few times, you start making bigger bets, and then all of a sudden you realize, well, it wasn't right, and you lose much more.
Yeah.
So early success actually hurts somebody in that respect because they start thinking that they really can do it.
and over the long haul, which is really what matters.
Markets are the markets,
Yeah.
and stocks are individual pieces of the market. Bonds are individual pieces of the market. We have no control over that. But we have to use them. So we have to use them in ways where we can some way get an outcome that we want, and that without subjecting ourselves to the potential outcomes that we don't want.
Yes, and it seems to me that if you take a lot of risk, you can either get maybe a huge reward, or you can have a horrible reward. The range of possible outcomes is broad, and I think that's one thing that needs to be addressed here. So this is what we're going to talk about. We've done videos on this, and I haven't done this particular example that we're going to give on the podcast because it does have a lot of charts, and obviously we can't show charts on an audio podcast, but I'm going to describe this, Professor Plum, because I do think the concept is important, and I want you to comment on this, and we're going to talk about ways to manage risk, and if you already know us, you probably know what way that is, but let's get into this here. I'm going to take this hypothetical situation to illustrate why it's more important to manage risk and not rate of return. A great example, because we had 2 decades that from January 1st to 1990 to December 31st, 2000. Call it 1990 to 2000. That decade did great. The next decade, 2000, 2010, was, I would say, bad, but it was nothing. I mean, it was basically zero. So that's not a good rate of that's not a good decade, let's say.
Now, you say the 90s were a good decade. Well, they were a good decade, unless you were Orange County, California, that went bankrupt in '94. Was it? I think it was.
Yeah.
So even really smart people in really good, as you mentioned, decades can screw things up when they accept the wrong kind of risk for what they're trying to accomplish.
You are so correct. You are so correct. All you got to do is look up Orange County, California, 1994. I think you'll see what we're talking about. But let's take the decade as a whole here. So let's take this situation. I'm going to do a hypothetical situation. I'm going to take two individuals who retire on January 1st of 1990. Okay? That's it. Both of these individuals have $1 million. And their idea in January 1st, 1990, they just retired, is they want to take $45,000 of annual income from this $1 million with an adjustment each year for inflation. What do we think?
4.5% distribution.
Oh, yeah, exactly. 4.5% distribution. And they want a little bit of a raise, I don't know, 2-3%, something like that each year that we're going to give them every year. So one of these investors with $1 million on January 1st, 1990 diversifies their portfolio. They're putting in an equal mix of U.S. stocks and bonds, international stocks and bonds, real estate, and some commodities. So they got a potpourri of stuff. I would call it a fairly diversified portfolio of this $1 million. That's one. Now, the other person who retired on January 1st, 1990, just places all of his assets in the S&P 500 and also is going to take $45,000 a year, plus every year a little bit more for inflation. Now, about that
time, there was a popular theory, been completely debunked by now, that it was written about in some books, and actually some big name recently said the same thing, but most people have disregarded this. Well, the market average is 10%, so you can take your 4.5, 5, leave money in for inflation, and you're going to do fine. And so there was this weird belief that average is what mattered. So my average, stock market return of 10%, no problem. This is a slam dunk. We can make this work all the way. Why would I want to diversify more than just diversifying into the 500 biggest stocks in the U.S.? So why have bonds? Why have international? Why have real estate? Why have other, types of investments that zig when the market's zagging? Because it averages 10%. Life is good. Now, as I said, that's been completely debunked, and this is part of the way, this is what happened to it as we go along here.
Yeah, I think so.
But that's why somebody might have done something like this.
Oh, absolutely. And I don't think that idea is dead. It just goes out of favor. I'm sure it'll come back. And I should say, when I say place the assets in the S&P 500, you can't invest directly in an index. I'm just saying they put it in the ETF.
You bought an index fund, or you bought an ETF. I don't think even the ETFs existed back in 1990.
Maybe not, but a fund that mirrored that. Okay, so
that was available.
Yeah, I just want to throw that in for people. Okay, so here's the deal. So we have these two investors. Now they're taking $45,000, maybe the next year a little bit more, next year a little bit more, 2% raise, something like that. So after 10 years, okay, now they didn't know this. They had no way of knowing this in 1990, but this, as I said, was a good decade for stocks, really good decade for stocks. We had the nice dot-com bubble, we had this, we had that, and it was just pretty good. So the let's take the investor that just did the S&P 500, okay, the guy that just threw his stuff in the S&P 500 and took 45,000 plus change out every year. They had a big decade. Do you realize this $1 million from 1990, by December 31st, 1999, in this hypothetical scenario, they had a little over $3.5 million. All right.
And that was after taking out about 500,000 in distributions over the years.
Yes, at about 3% inflation, this person is taking roughly $60,000 a year of income, cash flow, by the year 2000. Now, 60,000 is what, about 1.7% of the portfolio. Okay, so that's the S&P person. Now, the diversified individual hit the year 2000 with about a $1.3 million. That's a little just shy of a 5% rate of withdrawal. Not as good as the S&P guy, but not
Obviously
bad.
Not.
So,
okay, and it was a good decade for stocks. It was a so-so decade for bonds, and so in that respect, you wouldn't expect that portfolio to do as well. And so if all you did was look at these two ending results, it's like, wow, one of them's almost 3 times as much as the other one. That must be the preferred and best method of work. Let's do it that way all the time.
Well, yeah, and just just looking at it that way, it would seem to be This person just stuck this in this exchange traded fund or whatever it was that mirrored the S&P 500 and didn't really do anything, took an income. Now, Professor, how is that, just very, very quickly, how is that possible that somebody can be taking 45,000, then 48,000, then 50,000, whatever it is, every year for 10 years out of this $1 million portfolio, and still they wind up with, a ton of money after 10 years?
There weren't any down years for stocks in that period of time.
Yeah.
They did not have a negative sequence of returns. They had nothing but positive sequence. In fact, the diversified portfolio had a little bit of negative sequence of returns with the bond portfolios, but for the most part, the guy that did the stocks in the 90s had no negative sequence of return, and the average was much more than 10% over that decade, because that was pushing us right to, at the time we did not know this, although we knew it was coming, we didn't know when it was coming. We were just on a skyrocket in the dot-com build-up. I won't say bubble yet, because at that time a lot of people didn't believe that it would ever change. Of course, that was kind of short-sighted, but
it did, and so
it worked really well right up until it didn't,
which was shortly after January 1st of 2000. So that's the
one.
Like
what, March 20th?
March 10th was my date, but
that was when you got in.
No, that was my high point. I got in February 28th, so I was in 10 days. All right. So anyway. So 10 years goes by, and both of these individuals are doing pretty well. The S&P 500 person is doing very well, and the diversified person, they're still doing fine. You know, they still got more than they started with, and they took an income.
Their distribution rate is in the 4.5%, 4.8% range.
Yeah, but they're not in any danger of running out of money, at least not in their minds. Okay, so that's the first scenario. Now, here's the second scenario, and this is where this really starts to turn. So they have two younger friends now. They look at these other two people who for the last 10 years have done pretty well, no matter what they did in the market. And these two younger friends are saying, man, you two did really, really well. And they said, hey, listen, my buddy and I, we have $1 million each. Again, this is a hypothetical situation, okay?
Makes the math really easy.
It sure does, and the timing too. So they said,
first, get $1 million.
Right. So they retired January 1st, 2000 with $1 million, and they said, I'm going to do the same thing. I love this. This is great. We can make this work. So these two different individuals, start taking also $45,000 per year of inflation-adjusted income starting January 1st, 2000, thinking that this could be an easy thing. Our two buddies who started 10 years ago are doing really well. So we're going to do the same thing. In this case, one of the individuals diversified and the other just went the S&P route, just like the previous
two.
Right. So, but what they didn't know that we know now is that this is I said it was a bad decade for stocks. Bad decade.
It was a bad decade for stocks.
It was bad in the sense that you had virtually zero return for 10 years. Isn't that how it goes?
Yeah. If it was a bad decade from start to finish, from January 1 to December 31st over that decade. But there were times during that decade where the stocks did really well. So if you could time it, you did really well. But so far, I've never found anybody who can time it. But the problem was the investors ran into a very, I would say, severe negative sequence of returns, where the first people from 1990 to 2000, they did not have a negative. They didn't have any negatives in their stock market portfolio for the first 10 years. And so they were going to do fine going forward. But the second group of people who started 10 years later, they had several bad years. 3 of them right off the bat. 3 negative years right off the bat in the stock market for that decade.
Yeah, 2000 to 2003 basically was not good. So where do these individuals end up, Professor Plum? But let's say December 31st, 2009. These two people who started off so promisingly in January of 2000. What did they have left after 10 years?
Well, the one that was diversified, actually ended up right about where the first one that was diversified ended up. They ended up with about 1.3 million after 10 years after taking out the distribution. So whether you retired in this particular case, whether they retired in 1990, pulling the 45,000 a year out plus inflation, or whether they retired in 2000 with the diversified portfolio, stocks, bonds, and the others, they ended up with about 1.3 million at the end of 10 years. Either way, where the big difference was that pure stock market investor, where in the first 10 years, they took out all their money, cash flows over the years, and ended up with $3.5 million. The person that started this in 2000, at the end of 10 years, taking the money out every year, only ended up with $400,000. So that's going to leave a mark. That's not a very pleasant way to deal with it, because now if you want to maintain and keep taking your $58,000-$60,000 a year out, that's like a 15 to 16% distribution rate going forward. Most people will understand that taking 15% a year out is not sustainable for a whole many years going forward.
No,
it's going to deplete the portfolio, even if you get good returns. If you're just trying to make 15% just to break even, that's a tough one to deal with. And so you have a pretty good idea you're going to be broke you're going to be broke within the next decade for sure.
Yeah, the one who took what seemed to be a good risk in 1990 and just sat in the S&P 500 and took an income went from $1 million to 3.5 million. And this person that did this from January 1st, 2000 to the end of 2009. It was under 400. It was 369,000 to be exact, from their 1 million. And yes, that now that they're taking 58,000 a year because they had to take a raise every year. That's, as you're exactly right, 15.6%. So, okay, so
but you know what's really going to happen here before it gets down to that 360 or 400, whatever the number is. That particular retiree is going to change their retirement. They're going to stop, to the extent that they can, they're going to stop spending money. They're going to stop living the way they want to.
Yeah.
That's a sucko way to retire. Where in one case you could be living high on the hog, and in the next case you're in the wallow. You've got nothing left. You've got to change everything. You can't do what you planned on doing. And you may have to change a lot of things. You may have to sell the house you live in and move down to it to some place you don't like. I mean, you have to change dramatically. Your emotional situation, your stress level is through the roof.
Well, and the biggest point of this is that the two who retired January 1st, 2000 did exactly the same thing with the exact same investments, really, as the two people who retired in 1990. But they had dramatically, I'll say both of them really. Well, they didn't both have dramatic, but they did. They had dramatically different results. And what this says, though, is that if you retire just at the start of a good run for stocks, you are probably in a better position than if you retire just prior to a really bad run for stocks. And the problem with this is that you don't know ahead of time when that good stock run is going to start or when that bad stock run is going to start. So,
but the studies are also out there that say if you can make it through the first 15 years without experiencing negative returns in your not having to sell in negative periods of time. If you can get through the first 15 years, you're going to be okay. Yeah, and so most likely you've got your odds of running out of money drops to like 1% over a 30-year period of time if you can make it through the first 15 without selling at a loss position. And so having that lower volatility. Now this is all about taking distributions. This is not about accumulating wealth. It's not about a 10, 15, 20-year time period where we're trying to create a net worth. This is retiree talk. And this is about taking money out of a portfolio. The volatility doesn't matter too much when you're building the portfolio because it actually can help you when you're dollar cost averaging into your 401k, into your ongoing savings and all that, and time is on your side. But on the other side, when you're pulling money out of a portfolio, that negative potential sequence of returns, having to sell something when it's in a down position is what really dramatically hurt that second block of years for the person that was in that more volatile portfolio. Volatility is not the problem. It's the way that they used the volatility. They took the volatility and turned it into risk.
Boy, you said it perfectly. And we've done other episodes where we say volatility is not risk. The culprit here is not the volatility. You're going to have that anyway. The culprit is the removing of the money during the volatility, taking the money out for income, for cash flow. Now, okay, but these people had to live on something. They had to take a cash flow from somewhere. And this is where we're going to talk about just for a moment, because we don't have a ton of time left. But I want to pivot here and talk about, well, if we can't manage rate of return, because rate of return is basically what it's going to be, and I need a certain amount of cash flow, we need to manage risk. So talk, if you would, Professor Plum, about how we're going to manage risk. What should these people have done, as if I didn't know?
How are we going to manage risk? We're not going to manage risk. We're not going to play the game. We're not going to subject ourselves to risk. Anything that is volatile, we're going to leave alone for that 10 plus 15, hopefully 15-year time horizon, to take the risk of it out of it and accept the volatility, because that's where we get our returns from over time. Keyword, over time. Now, that time may be the next year. Maybe the next year goes up a bunch. I don't know. But generally what we've seen is that over 10 plus, over realistically 15 years, that's where we get even the bottom 15-year periods of time have been inflation plus. And so we're trying to get those returns so don't play the risk game. But that means you have to put some money on the sidelines that says, I need to draw something from something that does not have risk or does not have volatility that I could inadvertently turn into risk. I need to be able to draw down something to allow the other assets to go through the volatility that they're going to go through. Bucket number one.
Which is,
I'm going to put enough money on the sideline to cover my needs, the goals, the expenses. So in this case, if I wanted $45,000 a year plus inflation, just a very simple one. You put $45,000 or $450,000, $500,000, half the portfolio in laddered treasuries. No risk there. Every year it matures, you get the money you're going to spend, and you leave the stock market money alone for 10 years, and you let it grow. You let it come back, and you don't worry about the volatility. And you let it grow. That's what we do. We time segment our distributions. Bucket number one is the money we need for our short-term liabilities. Liability being I need to spend money, and I'm going to put enough there to cover 6-7 years worth of cash flow. Then I'm going to put some, but I don't want to do 10, 15 years of bonds. I'm sorry. I still like return. But then you can do things that get better rates of return over longer periods of time. I mean, heck, you can get probably fixed investments that pay 5+% on a guaranteed 7.
Well, the question's going to come up, though, and we get this quite a bit, and we have an answer for it. But if you had, we're going to say bucketize the individual in 1990, the S&P 500, the person who just, put the money away, and they wound up, they turned their $1 million into $3.5 million, even taking a distribution every year with an inflation adjustment, still wound up with that. If you had done that in 1990 and you had siphoned off some of that S&P money and you put it into something safe that you just said, non-volatile, we'll call it that. I mean, what does that do? Wouldn't that really do? I mean, they're not going to be left with $3.5 million because
no, they won't have 3.5, but they'll have more than the 1.3 as well. Yeah. They won't be as good as the best of times in the stock market, because the only way to get the best of times in the stock market is to be in 100% in the stock market. But to be 100% in the stock market, you have to accept other than the best of times as well, because we don't know what's happening over the next 5-10 years. It's just, that's the unknown. So giving up a little on the high side to maintain more on the downside. And while a 25-year-old may not understand that concept, a 65-year-old probably does.
Well, a 25-year-old, of course, again, has time. And we've said this goes back.
And what if the market goes down 50% on a 25-year-old? Their $4,000 Roth turns into $2,000 for a little while. It doesn't affect their current lifestyle.
It better not, because they're putting this money away for the next 35, 40 years.
and they're saving more money next year, next month, or whatever the case, to buy it at it's a sale at pennies. We're buying it on sale, and it lets it grow for the next 40 years.
Well,
they will do fine.
And this is why we've said so many times that the skills you need to build wealth are vastly different from the skills you need to keep that wealth once it comes time to use that money. So,
and yet there are so many more books, so many more papers, so many more everything written about how to build wealth, and not that many things written on how to distribute that wealth that wealth so that I can live on it in my golden years.
Wasn't that a David Bowie song? Thinking about it. Anyway,
I don't know if he was talking about this, though.
I don't think so either. But the concept here is that since you don't know what's going to happen over the next 10 or 15 years, the idea is to be prepared for something, for anything. And I'm sure the person who started in January 1st of 2000 thought they were going to be just as well off as the person that started in 1990. But as it turned out, they were taking a huge risk, and they wound up with about 60% less money in that portfolio by the end of 2009. And again, this is a hypothetical situation. It's a little bit ridiculous to throw out numbers like this, but it's done
and it doesn't even have to be 10 years apart. Take somebody who retired at the beginning of 2007 compared to somebody who retired at March of 2009. If each one of them had $1 million, the one that retired in 2007 was having some problems because for the next year and a half, his portfolio went down 50%. And if he's still trying to take money out, it's going to be hurtful. On the other hand, the person that retired in 2009, specifically March, saw some great, just wonderful returns, recovery returns from the first 2 years. First 2 years
over the next probably 10, 11 years.
Decade,
like
yeah.
So,
it's just great. Timing is everything.
Well, it is.
But you don't know how to time it. It's impossible to time it.
So you got to be ready for it. And this is why we talk about this. And the other thing I want to make sure that people are aware of, you mentioned, taking, somebody needs $45,000 a year. Maybe you take out 45 or 450, 500,000, something like that.
Well, that's a 10-year, that's a simplified 10-year bucket.
Well, yes. But what I'm saying is that it's not a 2-year thing, as some people have described. They say, well, it's 2 years, 3 years of maybe save money. You can take cash flow.
Well, and let's just talk about it because it's a big thing. You put 2 years of cash aside, you'll be fine. If you put 2 years of cash aside in 2010, what did it get you? It got you to the bottom of the market before you had to start selling. If you did it in 2007, what did 2 years get you? It got you to the bottom of the market before you started selling. You didn't even get to sell anything on the way down. You sold it only at the bottom. So you need more because the average downturn. Now, recently, our downturns have not been all that long, but that doesn't mean we're not going to face another one at some point in the future that is more traditional, more, it usually takes, 12 to 18 months from top to bottom, not like the COVID 6 weeks top to bottom and then recover. So we have to look at it and we have to be better prepared. And the thing also is, in any given year, 2020 was a good year for the stock market. If you were in from January 1 to December 31st, 2021 was a good year. 2022 was bad year.
Yeah.
So, but even in those good years, 23 was good. There were times in that year where you were down below the January 1st mark.
2020 especially. You remember?
Definitely 2020, but in 2019 as well. So if you're taking money out of the portfolio on a systematic basis, at some point you're taking money out in a loss. Losing money, selling low is not a good way to have a viable, portfolio.
Didn't they teach you? Isn't that one of the first things they teach you in stock school? Like day one, buy low,
sell high,
But human nature is to do the exact opposite: is to buy high and sell low. Why? Because you're
panic.
You're panicking. You're panicking on the downside, and you're overcome with greed and excitement on the upside. And I don't care if stocks have doubled. I'm throwing more money into it at these prices.
See this. With the market inflows, when the markets are running high, more people are putting money in to the stock market investments. And when the markets are down, like in 2022, people are the flow is negative coming. The markets money is coming out of the markets. That's the exact opposite of what should be happening. You should be putting money in when the markets are low and not when it's high.
But
that's not human nature.
Tell people that, though. Tell people in 2008, late 2008, you should be buying. And the answer will be, are you nuts? Now, this isn't to say that when the markets are going crazy that you should start selling everything off. We're not talking about timing it in this fashion. And I want to leave people with this particular note. This is not timing. When we say buy low, sell high, we're not talking about that. What we're talking about is taking advantage of.
Well, first off, protecting against selling in the downturn.
Yeah.
Protect yourself against having to sell something when it's down to raise cash for a known expense. And then on the other side, take advantage of the positive volatility. Protect yourself against the negative volatility and turning it into risk. Mm-hmm. Take advantage of the positive volatility. I'm not saying that you should wait until the high point to sell, because you'll never know the high point. Mm-hmm. The only way you ever know the high point is looking back at it when you're down from the high point. Yeah. So when you're above expectation, let's take some cream off the table. Let's not be greedy little creeps, and let's manage our portfolio for our benefit as efficient. Take advantage of what the market gives you. Protect against what the market also takes away from you.
Well, the most important part of what you just said was to protect yourself, because the best offense is a good defense. I don't know, whatever that is. But the saying really holds true. And I just want people to know we're not talking about timing anything right here. What we're talking about is protecting yourself on the downside. And then when you talked about taking cream off the top, that's a whole other strategy where we can talk about value averaging.
It all works.
Yeah, I'm going to say this. It all potentially works. May I say that?
Oh yeah, I got to get this.
Yeah. There's no guarantee.
Appliance available.
There is no guarantee on any of this stuff. But let's just say that.
I can't guarantee the sun will come up tomorrow, let alone that the market will go up.
Well, that's probably true. If you want to learn more about this, and regular listeners know a lot about this stuff, but it's important to remember it, and it's why we talk about this kind of stuff all the time. You can talk to any of the advisors at Lucia Capital Group, and I would urge you to do that if you haven't done so. 800-644-1150. 800-644-1150. You can also learn more about this, what we're talking about here. I think a lot of this, if not most of it, is in our bucket strategy guide. So if you go to the search bar at the top at luciacap.com, type in bucket strategy, you'll be able to download for free. You'll see this result. Download for free. I believe it's a PDF. It's probably 30, 40 pages. Take a look at it, read it at your leisure, and I think you're going to get a lot out of it. Along with many of the other guides that we have, I mentioned this quite a bit. You have an estate planning guide. You have a Social Security guide, several others. Go there at luciacap.com. You can also find videos and all that kind of stuff. We did do a video on this, and it was a few years ago on this exact same topic with a wonderful chart. So maybe you can search for that on luciacap.com as well. Don't forget to subscribe. Do subscribe to this podcast, Spotify, Apple Podcasts. Both of those contain our wonderful show, Managing Your Financial Future, and make sure that you download every episode to your device so that you don't miss a single thing. And sometimes when we repeat, I don't want to say repeat topics, but we've when we talk about topics like this, when we talk about buckets, when we talk about value averaging, when we talk about the importance of having safe money, non-volatile assets on the side, and we do it a couple of different times a year, it's really mainly to reinforce this point, which, Professor Plum, it's got to be one of the most important things that I think a retiree can do. Would you agree? Protecting yourself on the downside.
Well, if one of the biggest concerns that retirees have expressed is running out of money before they run out of time, then yes, protecting to avoid that is an important issue in your life.
I think you've understated that point, but this is why we talk about it. So I appreciate you being here. We will talk more about this at a later date. For Professor Rick Plum, certified financial planner professional, accredited wealth management advisor, I am your podcast host, Johnny Dean. Thanks for listening. Thanks for tuning in. Managing Your Financial Future. We will talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. A dollar cost averaging strategy or value averaging strategy does not guarantee a profit or protection from loss. You must consider your willingness to continue purchasing during periods of high or low price levels. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth IRA was established, whichever is longer. Stock investing includes risk, including fluctuating prices and loss of principal. Before investing, carefully consider an exchange-traded or mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by full faith and credit of the U.S. government, but are subject to inflation risk. S&P 500 index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.